Hello, my fellow investors. I want to make you a video about Monish Pabrai's 10 Commandments. I have a lot of criticism on his commandments, but I just want to start off by saying that I genuinely respect Monish Pabrai. I learned a lot from him, and I think probably almost every young investor or new value investor has a lot to learn from him. He's very well educated and he's very good articulated. He knows how to explain things very well. In some ways, I think better than Buffett and Munger. And I think a lot of people like him because he really knows how to explain his stuff very well. So I really respect him, and I also think he's a great ambassador for value investing. But putting that aside, I think his 10 commandments have a lot of flaws in them. And I think the reason for that, the main reason, the core reason why his commandments are flawed is because he's a cloner. He's a very unique cloner and a very good cloner, but cloners have a problem with the way they think. It's good for them, but it's not always good for other people. And in my opinion, he's a little bit narrow-minded, and that's why if you don't think deep into his commandments, sometimes you won't realize all kinds of different things. So that's the point of this video. Let me start off. This is Monish Pabrai's channel, and he calls his 10 commandments, he calls it the 10 commandments of investing management. He doesn't say the 10 commandments of value investing. The 10 commandments of investing management. And this is something that really ticks me off, and I'll explain myself. He's giving here a lecture to students. He's not giving a lecture to money managers. So if already you're making a list of 10 commandments, why make a list of 10 commandments of investing managers for management? Why don't you make a list for young investors? Give them good advice how they should start off their career investing. And it's not just that, it's much more than that. Because out of his 10 commandments, only 2 of them have anything to do with management. The other 8 are just general advice in investing. So the reason why it ticks me off is because there's a lot of things, let's say the Buffett or Warren or Charlie Munger or other great investors say. I could disagree with them, I could think differently, I could think maybe they're wrong. But it was very, very weird to hear these people saying like something like totally stupid. And when you hear a person saying, I have here 10 commandments for investing managers, and then you go on and make a list, and only 2 of them have anything to do with management, and 8 of them are just general advice. So decide, if this is advice for managers, then why are you giving a lecture to students who are not even investing? And if it's for managers, then why only 2 of them have anything to do with management? And if you're making a list for average investors, so just make a list for average investors. Why are you calling it investment management? Advice for investment management. It's just like, it sounds like stupid, this whole thing. So when you hear someone saying something that just, it doesn't make sense, so it like takes you off and say that this person, like, is something wrong. And another thing that bothers me is if you would have been saying these are my 10 commandments. Let's say he's speaking to his investors in his fund and he's saying, listen, you want to know who I am? These are my 10 commandments. Okay, I have no problem with that at all. But he's not. He's saying, like, if you listen to his introduction, he's like saying, like, whoever is, any managers who aren't going by these 10 commandments are like they're sinners and they're violating the laws. I know he doesn't mean that, but what I'm saying is he's taking these 10 commandments to a huge extreme, way out of its proportions, in my opinion. And when you see a guy saying something and like, you say, way off, and it just, something's wrong. You say, it's very hard to listen to these people when you're saying they have so many things that aren't exactly correct. So let me start off with my criticism of his commandments. And I just want to say I agree with a lot of the things he says, but that doesn't mean there's a wider picture to all these things. Okay, so let's start.
So anyway, the first commandment is, thou shalt not skim off the top. And what the Lord means by that is that, one of the things with all these commandments is that the reason they are being presented is that most participants in the investment management business violate them, and they are sinners. And so we are trying to kind of improve the lot, if you will. So skimming off the top basically is setting up an investment operation where you're either taking, some percentage of fees as a fixed fee, and in the case of hedge funds, they're usually taking 1 or 2% of the top, and they're adding performance fees on top. And two of the the original practitioners, Warren Buffett, Charlie Munger, they practiced the art with no fees off the top. So Buffett had, I think, 0.625 once he merged all his partnerships, I think in 1962, where he took no fees off the top. And Charlie, I think, had a third, I think 1/3 above zero is my belief. I think that's what he did. But of course, that was a kind of specialist operation, little different operation that he was running. And
Okay, so here's my first point. And he's bringing out a point that Warren Buffett and Charlie Munger didn't skim off the top. And he's like calling everyone else sinners. Like, this really pisses me off. Just because Warren Buffett and Charlie Munger did something doesn't mean everyone has to do it. And just because they did it doesn't mean that's the only right way to do it. It's like you're taking like the two top investors of the last who knows how long, and you're saying this is what everyone has to do. If you don't do what they're doing, then you're wrong. That doesn't make any sense. I get his point. His point is very valid. I'm going to get to that soon. But I'm just saying, I just want to point out the way he thinks. He thinks if Warren Buffett does it, if Charlie Munger does it, then you have to do it. That is a mindset of a cloner. It could be very good for him, and it doesn't mean it's good for someone else. And there could be tons of reasons why someone would act differently. And I just want to point out a different point of view, exactly the opposite point of view of what Monish is saying. I found this video recently, and I really like this point. And we as value investors usually don't think about these kind of things. But if you look into the mindset of a manager, or of someone who wants to invest his money in a manager, they can look at things totally different. Like, he's speaking as a manager, how a manager needs to manage his money. But there's a totally different kind of mindset that's coming from people who don't want to manage their own money. They want to give the money to managers because they can't manage their own money. And I'll show you this clip, and you'll also see a totally different kind of view, how to look at all these things.
The first question is, why do people need an advisor if they can just put their money into the S&P 500?
It's a great question. I start every prospective client meeting by saying, you're probably here because you think you need an advisor. You may need an advisor, but not for the reasons you think. The reasons why you would need an advisor are you don't have the emotional and psychological stamina to hold on. And if you don't hold on, it's a disaster. I was once speaking at a conference, very, very big conference, a Wall Street conference. Guy got up in the back of the room, took the mic and said, your ilk are the biggest crooks in the world. I said, I agree, but why do you think so? And he said, because you charge fees while clients are losing money. I said, I actually completely disagree with you. I think we're crooks because we charge fees when clients are making money. He's like, what? I said, you heard me. You see, in an up market, you don't need me. It's easy. You bought anything in 2020, latter part of the year, and you held it through 2021. A monkey made money in the market. My 4-year-old throwing darts at the wall made money in the market. Why do you need me? You need me because last year and this year, it's really, really hard to hold on to that roller coaster. So the first and foremost thing, as I said before, is I'm a psychologist. It's worth it to hire somebody if you have enough money that irrationality and stupidity will derail you. If you are a completely logical, data-driven investor, by all means, you do not need anybody. The second reason why people hire investment advisors is for everything else. It's planning, it's taxes, it's wealth transfer strategies, philanthropy, and so on. Some will say asset allocation. Today you can go online, use one of these robots, and they'll allocate for you all on their own. If you can ignore it, you don't need to hire anybody.
So I just wanted to point out he's speaking about a financial advisor. But the same point could be said about Monish Pabrai's hedge fund managers. Is some people, they just can't invest alone. They'll lose a lot of money if they invest alone. And that's why the hedge fund isn't such a crooked way he makes it if it skims off the top. It's not such a bad thing because some people will lose actually more money by investing alone than by doing it through a manager. So that's just the other side of the argument for Monish Pabrai's point. Okay, so I want to continue on with another point in his first commandment.
Capital. But the bottom line is that both Buffett and Munger have said that if you're in the investment management business, what should have already happened before you set up your own shop or started managing other people's money is practice the art with your own limited assets. And if you did well with those assets, then the power of compounding is such that even a small amount of money becomes quite significant after a few years. I mean, if you're compounding at anything north of 15, 20, 25%, which you should be able to do on small amounts of capital, I mean, your money will be doubling every kind of 4 to 7 years type deal, and so even a small amount becomes fairly large in a few years, which gives you the ability to in effect live off that base while the assets are growing. So anyway, that's the
Okay, so I just want to say I agree that if you want to give advice to someone on where to invest their money in which management fund, I'll say yes. If you have a manager that doesn't skim off the top, that means he's probably more ethical and he's probably more committed to his investors. So that'd be great advice. If the command would be don't invest in funds that skim off the top, that would be a great commandment. But when he's speaking as a commandment for a manager and he's saying the reason why not to skim off the top because you should be already rich by now. So I agree that the most highly ethical and moral thing to do is not to skim off the top. But it doesn't. I wouldn't make it a commandment because we can't build a commandment based on what we wish reality to be. We were saying we want the person who's managing the fund to be already rich because he already has 20 years of experience and he probably doubled his money by now. But what if he has a big family or tons of medical expenses and he couldn't have any savings and he's not rich? But he's a great investor and he's a very successful investor and he knows how to manage other people's money very good, but he still needs a living and he's taking a fixed fee. Is there any problem with that? I don't see any problem with that. Of course, I'll be much happier to invest in a person who's not taking off any fees for my investment. But to say it's a commandment for a manager not to take off any fixed fees, I don't see this as such a high ethical thing to say this is a commandment that you should never do it. And he calls them sinners. But I'm saying, even if we're taking it a little bit of an extreme, I disagree that such a thing should be a commandment. I don't think it's such a bad thing for a manager to skim off the top, to take a small fixed fee if he needs it to run his operations. I don't think it's such a bad thing.
The second commandment, thou shalt not have an investment team. So again, investment management is not a team sport. It's really designed to be an individual pursuit, and an investing team is in many ways an oxymoron. And one of the there are many reasons why it's an oxymoron, but one of the basic reasons is that any two humans are going to have differing circles of competence, and so if I were to have, for example, an analyst on my team, and that analyst was very bright, and he or she came up with some investment ideas, I may reject them simply because I have a different circle of competence, and so which is really not doing justice to the analyst, if you will. And
okay, so here is exactly where Monish Pabrai shows how his mindset is like of a cloner. Warren Buffett has a famous saying that the best ideas come when you sit down in a room all by yourself and think about investing. That worked great for Warren Buffett, and it worked great for Charlie Munger. That's the way they are wired. That's the way Monish Pabrai is wired. And by the way, I'm wired the same exact way. I sit alone, and I do my own research. So I'm criticizing Monish Pabrai, although I do exactly what he says. Because I think just because I'm like that, and he's like that, and Warren Buffett is like that doesn't mean that's a commandment that applies for everyone. Actually, most people in the world are wired totally differently. They can't work alone. Most people need to work with other people. So this is like, although I totally agree with his sentiment, because I do it myself, but it's like the most, it's like stupid advice to give someone to say, just because I'm like this, that's where you should be. It just shows like a total lack of understanding of human nature. And almost, I study tons of value investors. Almost all of them have some kind of an investing team. Some have a bigger one, some have smaller ones. And the reason for that is some people need to divide all the things in their fund to different departments. One is taking care of the investors, one is taking care of research, and one is taking care of that, and one is taking care of this. So it's like total stupidity in my mind to say you shouldn't have an investment team. And even his point that he's bringing up that two people have different circle of competences, I say that's exactly why someone should have an investment team. Because why commit yourself only to your circle of competence? Why not take another partner if you find a good partner that's like you, and he has another circle of competence bigger than yours or different than yours? Why not? That's exactly what a partnership is. We have two people, each one is good at something specific, and the two of them together, they're better than each one by themselves. That's the whole point of a partnership. So he's saying, don't take an investment team because they have a different circle of competence than you. That's the exact reason why you should take one. So you're not trusting them. You don't want to invest on their analysis. So find someone who you really trust and you think is a really smart person, and he has a circle of competence that's different than yours, and that's exactly why you should take him as a partner and add on to your investment team. One is good at this and one is good at that. The exact reason why he's saying why you shouldn't take an investment team, in my opinion, that's the exact reason why you should take someone onto your investment team. But again, it just shows how his mindset works. He's a cloner. Warren Buffett did this. Charlie Munger did this. I'm doing it. It works for me. That's what everyone should do. That's a very flawed mindset. You should think the way people need to understand human nature. This is what's good for me. That doesn't mean that what's good for me is good for someone else. Okay, I just want to continue on with commandment number 2. He has another point. I want to say something about it.
Justice to the analyst, if you will, and the second is that we don't need that many stocks in our portfolio, and so in a year we have plenty of time to research many stocks and to find 2, 3, or 4 of them that kind of fit the bill, if you will. So they shouldn't. And the other thing is the investment analysis process is really the fun part of the job. So you really don't want to be delegating the fun part, because I wouldn't know what you'd be doing then if you weren't kind of analyzing investments. That's the most fun part.
Okay, so here's the part that he's saying that the fun part is analyzing. Again, it's just not understanding human nature. Most people, it's very, very hard for them to work alone. So if you're taking on a partner or investment team just for the sake of being social, most people are built like that. So most people are wired. So maybe he and Monish and Warren Buffett and Charlie Munger are wired differently. But again, I'm just pointing it out. Most people, it's very, very hard for them to work alone. Now, I just wanted to bring up this point before. He said that you don't need a lot of time to find a few investments a year. The reason why I bring this up is for afterwards. He's speaking about investing only in a few investments each year. And that's very important because it has to do something with his next commandment. That's why I brought it up.
Then the third commandment, thou shalt accept that thou shalt be wrong at least 1/3 of the time. And some of these commandments leaked out from God over the years, and this comes from John Templeton. And
okay, I want to point out this over here, this point where he brings up John Templeton. This is exactly why Monish Pabrai is a very successful cloner. Well, people have to understand the way a cloner works, the way his mindset is. He analyzes someone else, very good, and then he goes and he emulates what he sees by the other person to himself. Now, what happens if you emulate something to yourself which doesn't work good for you? That'll be a great disaster. When a successful cloner, he knows how to pick what things to emulate and what things not to emulate. And till now, almost everything Monish Pabrai does or thinks is like Charlie Munger and Warren Buffett. Over here, he's bringing up something from John Templeton. And this is exactly why I think Monish Pabrai is very successful, because in this part, he can't be like Charlie Munger and Warren Buffett. And his commandment about knowing that you should be wrong at least a third of the time, like John Templeton said, it's exactly the opposite of the way Warren Buffett and Charlie Munger think. There's a famous, I'll bring this clip soon, the famous Warren Buffett about the punch card. If a investor has to think as if he has only 20 investments in his life, and he has to really work really, really, really hard, that he should make every investment to be as great as possible. Warren Buffett and Charlie Munger are wired exactly the opposite than what he's saying just now. You have to work and think in a way that every single investment means everything, and you should try as much as possible not to make any mistake. And that's why Charlie Munger and Warren Buffett are they're very much against diversification. They don't look only for put 25, 30, 40% of your portfolio in one stock, because they research a company very, 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 very deep. And when they come to a very strong conviction it's a great investment, they'll put in a huge percent of the portfolio in that investment. But John Templeton was exactly the opposite. He didn't research companies so deeply like Warren Buffett, but he had a huge diversification. He invested all over the world. He just looked for bargains. As much as I researched John Templeton, I never saw anything that he has how to invest in companies. He just looks for bargains. So, okay, you take up a portfolio, divide it into 100, 200 companies, look for the cheapest companies you have. A third of the time, you're going to lose money, but the rest of the time, you're going to make so much money, so you're going to cover all your losses. So over here, we can see Monish Pabrai going totally the opposite of Warren Buffett and Charlie Munger, and taking John Templeton's investment strategy and emulating it. And why? I think the reason is because Monish Pabrai isn't as successful as Warren Buffett and Charlie Munger. He can't research company, doesn't understand them the way they do. So he came to the conclusion, this part, I'm staying away. I'm going to invest, and I know I'm going to make a lot of mistakes in my life, and it's okay. That's what John Templeton said. So I think as much as it's funny to hear him saying totally the opposite of Buffett and Munger and emulating John Templeton, but that also shows why he's successful. He knows where to copy and where not to copy. And that's what I think is very unique about him. It's very, very hard to be a successful cloner. And I'm saying this I'm praising him. I'm saying this shows why he's successful, in my opinion.
We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, and because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it, and every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, particularly during bull markets. In stocks, it's so easy. It's easier now than ever because you can do it online. Just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one in the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Okay, so commandment number 4 of his, thou shalt look for hidden PEs of one. I have no problem with it. Good investment advice. You want to make a commandment, you want to make a commandment. I have nothing against it. I have no criticism. It's a great advice. If you want to put in his commandments, no problem with me. So I want to continue on to the next commandment.
Commandment 5, thou shalt never use Excel. So this actually kind of goes hand in hand with Commandment 4, and even it goes hand in hand with not having an investment team. But basically, if you can't figure it out in your head, so the investment process is really quite simple,
Okay, I want to stop here because this commandment is a lot to say about this. The way I'll put it about not using Excel, I'll say like this: the point is very valid, but the title is totally stupid. What I mean by that is, there's the commandment not to use Excel, and then there's the explanation why not to use Excel. So his point about the investment process should be very simple. That's a very valid point. If you can't figure out why something is a bargain, you have to use Excel to figure out why it's a bargain, then there's something wrong. But from there to make a title, to make a commandment, never to use Excel, the way I look at it is as if you want to tell someone not to smoke. You're telling him don't have a lighter in your pocket. It's like nothing to do with each other. Say the investment process will be very simple. If you can't figure out the investment process in your head, then you're probably not a good investor. And we need to break this down to a few different kinds of investments. If we're talking about cigar butts, and you're trying to buy $1 for 50 cents, then you don't need to Excel. You don't need a calculator for that. That's very simple. If you can't figure that out in your head in 2 seconds, then you have a problem. You know, like Peter Lynch says that even people who have 8th grade in math, they could be successful investors. Let me explain it like this. Let's say someone comes to you and he tells you, listen, I want to sell you my car. What's the price? $5,000. If it takes you more than 3, 4, 5 minutes to figure out if it's a bargain or not, then you have a problem. When we're speaking about cigar butts, it should take only a few minutes to figure out if it's a good price or not. Then you could research for hours, days, a week, a month, or whatever you want to decide how much you want to do research in a company if this bargain is worth buying. But it shouldn't take more than a few minutes to figure out, even if you never heard about this company and you have no idea what they're doing, it should be a few minutes to figure out if the price is a bargain or not. Then the rest of the work is to do research if this bargain is worth buying. So his point is very valid. You don't need Excel to figure out if a cigar butt is a bargain or not. But when we're talking about growth companies, and you speak about this later, then it's more complicated because if you're trying to figure out the future cash flows of the company, and you're saying don't use Excel because you can figure it out in your head, that's kind of a dumb commandment because younger investors, new investors, it's very hard for them to figure all this out in their head, and sometimes they need Excel. Okay, once you become more seasoned and you did this over and over and over and over again, then it will be very fast the process. So this wants to divide it between cigar butts and growth companies. Not everyone is so good at math, and sometimes you need help of Excel. It's like telling someone who's an accountant, don't use a calculator. If you're using a calculator, you'll be a bad accountant. No, he could be a very good accountant, and he still uses a calculator to help him. I don't see this as such a great commandment. Don't use Excel. And there's another point I want to say is why I think the point is valid, but the title is so stupid because sometimes when you say don't use Excel, it's a very generalization. I use Excel for a totally different reason. I use Excel not for the future cash flows. I use Excel for the past of the company. I like to put in all the info of the company of the past 20 years, and then I get a snapshot of the last 20 years of the company. I don't even use it for the future. I use it for the past. If I want to see the company in front of me, all its ratios, whatever I want to look at, and I want to get a very fast snapshot of the past 10, 20, 15 years, Excel is great. You could put everything in a small little box and you see the whole 20 years of a company. So that's what I'm saying. Maybe the point is very valid, but the title is so stupid. Like saying don't use Excel. And he himself, in the next commandment, he speaks about that he used Excel once for a different reason. So that's what I'm saying. The point is very valid, but the title is very stupid. The point is very valid. If you want to be a good investor, you have to understand the process in your head. It should be very simple. It shouldn't be very complicated. But from there to go on to say a commandment, don't use Excel, that's like total nonsense in my opinion. Okay, so this commandment 6, I think, is this great general wisdom in life. I have no comment on that. And commandment number 7, basically what he's saying is don't focus on macro. I think it's also great investment advice. I made an entire compilation on this issue of not focusing on macro. So I want to continue on to commandment number 8.
Commandment number 8 is thou shalt never short a stock. So I don't think we need to spend much time here, but that's pretty obvious, is we don't need to figure out what's going to happen to Tesla. That's, we don't need to go long and we don't need to go short. That just falls in the too hard pile. And so like Tesla for me, the stock, not the car, is there for pure entertainment purposes. Just to watch from the front row seats as opposed to being in the arena. So we just don't need to figure out exactly what's going to happen, and we don't need to go. So first of all, commandment number 3 is you're going to be wrong 1/3 of the time. I think with shorting, you're going to be wrong like 80% of the time. So both Buffett and Munger say that they've always been right on the stocks that they thought ought to be shorted, but they were always wrong on the timing. And the timing can get very painful. Also, the math is against you. Because the maximum you can make if you're right in a short position is a double. And we're not going for doubles. And the maximum you can lose is you can go bankrupt. So there's no point making bets where the highest upside is a double and the highest downside is that you're out of the game. So I shall go to my grave without ever having shorted a stock, and I think you should do the same.
Okay, let me just say one thing. I never shorted a stock. I don't think I'll ever short a stock. That's not my plans anyway. And I agree with him that it's be a great advice not to short. And I think shorting is very, very hard, and most people aren't very good at it. Saying all that, I made an entire compilation on shorting. I brought up a lot of investors what they have to say on this issue. But I have two points I want to say. First of all, when he's saying not to short, I would rather, if you would have made this commandment, don't short before you have 20 years of experience. I think that would have been a much smarter way to put this commandment. Because some people, they're very good at shorting. It's usually not good for people to do it before they have a lot of experience. But I have no problem the way he put it. But another point I want to add on is that there's another way to short, like Joel Greenblatt, when you make an entire portfolio made of shorting the most valued companies and going long on the most undervalued companies. I don't see that as a problem the way he does it, because when you're doing an entire portfolio of longs and shorts, that shouldn't be such a big problem. What really got me mad, and it's not in his commandment, but in his math. He says that in shorting, you can only double your money, but you can go bankrupt. That's like I think one of the dumbest things I ever heard investors say, because there's no difference if you buy a stock at 1 and you sell it at 10. It doesn't make a difference if you first bought at 1 and then he sold it at 10, or if you first bought at 10 and then he sold it at 1. If you know what I mean. If you shorted the stock at 10 and bought it back at 1, you made exactly the same amount of money as if you bought it at 1 and sold it at 10. So why is he saying you can only double your money? You are going to pay interest when you're shorting the stock, but you also have money which you can invest. I'm saying, but that's like something so stupid. I bought a stock at 1, sold it at 10. What's the difference if I first bought it at 1 and then sold it at 10? If I first bought it at 10 and then it sold it at 1. Actually, I made more money when I sold it first at 10 because I got money which I never had. When you bought it at 1 and sold it at 10, you had to have that $1. You could sell the $10. You need some margin. But I'm saying is, how did he get this math? I have no idea how he came to this conclusion that in shorting you can only earn double your money. Why can you only earn double your money? You can earn much more than that. So this is when I heard this, I was like totally dumbfounded. Like, and maybe he doesn't use Excel, so he doesn't have to do math. I don't know. I'm joking, but this is totally stupid. And I don't know. I have no idea how he said such a dumb thing. That's I don't know. Maybe you could explain it to me. Maybe I'm wrong. I don't know the difference between buying a 1 and selling a 10, and if selling a 10 and buying a 1. But I have to say, I totally agree with the point. Shorting is dangerous. Most people are not very good at shorting, but there are some people that are very successful at it, and if they're good at it and they live with it easily, then okay.
And then, commandment number 9 comes from Polonius. And even though Polonius came long after Moses did, he was the character in Hamlet. And Polonius said to his son, neither a lender nor a borrower be. And
I just have a small problem with this. It's so hard to make this a commandment because it depends on so many different things in general, and it told me so many different things in life. It could vary so much between person to person, between fund to fund. So to make this a commandment about not taking leverage, in general, I agree with the sentiment. Leverage is usually bad. But saying they're also not lending and not borrowing, this is much bigger than just investing. It's a much more complicated issue. Just putting it like the way like a commandment, not to use leverage, never to lend, never to borrow. But in general, it's very good advice. But it's very hard to go into specifics when it depends so much from person to person.
And then finally, commandment number 10 is thou shalt be a shameless cloner. So cloning is very good for your health. It's just there are many smart people who are great investors. In many cases, their portfolios are visible to us because it's required by law. And it's a great shortcut to look at what are the highest conviction ideas of some very smart people. And we have websites like Dataroma, for example, in the US, which is tracking a bunch of investors and telling you what the highest conviction bets are. And so I think cloning can be really good for your health. And
okay, so let me just say, you probably guessed by now that I'm kind of laughing when I hear this. I agree with him totally that it's very smart to see what other great investors are doing. But I think people need to understand is shortcuts are great when you know the long way. When people who look for shortcuts and they're willing to cut corners, they're usually people who aren't successful in life. People who are very successful and they know they made the whole long path to success, they know how to take shortcuts in the right way. So giving this commandment of being a shameless cloner, for me, it's like I'm laughing. It's like not right and not wrong. It's like, first, you have to know how to be a good investor and learn and strive to be a great investor. Once you learned everything you need to learn to become a great investor, then you could add this sidekick of looking at what other people are doing. Okay, it could be great. But teaching young people to become shameless cloners, in my opinion, it does more damage than good. Because you're telling them look for shortcuts in life. And when you tell people look for shortcuts in life, it's usually a bad thing. First of all, learn how to become a great investor by doing research and learning how to become a great investor. And if you reach that point, you probably wouldn't need and you wouldn't care what other investors are doing. You have so much conviction yourself. So for me, it's kind of funny. Yeah, if I look for investment and I find investment, and then I also see that some great investor invested in that company, I say, oh, wow, good. So he also thinks like me. But I'm not going to look for conviction in my investments because someone else did it. That's trying to find a shortcut instead of the long way. So that's just my opinion on his last commandment. And I'll be very happy if you have anything to say, put in the comments. If you think I'm wrong, if you have anything to add on, if you think Monish is right, or in general, anything you have about Monish Pabrai, I'll be very happy to hear your thoughts. I'm very much into analyzing great investors. As I said, I have a lot of respect for him. And maybe I'm wrong. And I'll be very happy to hear your thoughts on my analysis on him and what you think on Monish Pabrai in general. Thank you very much. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.